Coming up today, tech shares get hammered. What's behind the sell-off? Could it have further to go? We just got a rare market signal, and oil starts climbing again. Hey, what's up guys? Welcome back to Click Capital. And if you're new here and interested in stock trading and want to stay updated every day on what's happening across markets, along with staying informed on what's all the strongest markets and sectors out there, then go ahead and click that subscribe and notification button and you'll get an alert as soon as I've posted a video each day. And thanks to all my regular viewers who click that like button, helping to keep this show free of charge and continually hitting new records. Alright, let's dive right in. Bit of a pullback on the S&P 500 today. And just looking at market color, now got the Nasdaq below the 20-day, still got the Russell green across the board. Bit of a bump up in volatility today, still got bond yields downtrending, and we've now got oil, gold and energy above all their moving averages. Semiconductors below the 20-day, utilities still below the 50-day, Bitcoin green, dollar inflation expectations, growth and momentum turning down in red, and value green across the board. Bit of a continued rotation today. But like I've been saying lately, S&P 500 has been getting a bit technically overbought. You can see my reversal signals firing off there, and especially so looking at mega cap tech, almost touching the 50-day VWAP today. And just to put it in context, the pullback we had in April was a bit over 12%, and so far we're about 8.7% on the Magnificent 7. Just looking at the S&P 500, back in April we had a 5.9% pullback. That was the biggest pullback for the year. So far, this one's only 1.47%, so for sure it definitely could have more to go. And we did see the Russell 2000 take a bit of a breather today after it's had a huge rip this last week, but it wasn't a completely bearish breadth day across the board because the Dow Jones Industrials blue chip stocks actually finished the day higher. Still got 3/4 of S&P stocks above the 50-day average, and it might not feel like it today, but we've still got a lot more stocks hitting new highs than hitting new lows. In fact, on the NYSE and Nasdaq, still near rock bottom with stocks hitting new lows, so market breadth is still holding up. For sure, we got a pop in the volatility market. The VIX almost hitting 15 today. Again, no big surprise. We've been so low for so long now, and like I've been saying, we should expect volatility to increase going into the election. That's just following seasonality. Still got bond market volatility rather subdued. Same with oil volatility. Gold volatility is not that high. 2-year bond yield still really low here at 4.43. High yield bonds still holding up above their breakout. That's a good sign in price action. Pretty much just finishing the day flat. Dollar continuing to come down. That's a tailwind for stocks. Bitcoin taking a bit of a breather, and we got a bit of a pop today in oil. It's rolled over to the new contract now, trading at 81.70. But the big move was in mega cap tech. There's a look at Apple pulling back. Microsoft briefly dipping below the 50-day. Bit of a sharp sell-off there in Meta, down 5.6% on big volume. There's a look at Tesla. Got earnings coming from them in 6 days. But the biggest moves were in semiconductors. A lot of my regular viewers know something I've been talking about is the China risk and how the market's kind of been ignoring that and not really discounting that with mega cap tech and semiconductors. We've always known Taiwan could come into play. A lot of people underestimate how reliant big American technology companies and semiconductor companies are on Taiwan for their chip manufacturing and fabrication. There's NVDA losing its 50-day for the first time in a few months, down 6.6%. Pretty heavy fall there for AMD, over 10%. Getting a little bit of a bounce here after hours as I speak. Qualcomm, one of the hardest hit on earnings coming out of the Netherlands. ASML, and of course, the biggest chip manufacturer in the world, Taiwan Semi. Interestingly, Intel actually finished the day a little higher after it had a monster gap up. And that's because we're seeing a continued rotation into value stocks. It's actually finished the day higher, and still some really large rotations going on out there. There's the Russell versus S&P 500. Little stretched here in the short term. We could expect a little bit of a pullback or consolidation, but a sharp turn down in growth sectors versus defensive sectors and high beta stocks versus low volatility. Really big shift there, 4% today. Dow Jones versus the Nasdaq, pushing up really hard today. A sharp move up in consumer staples versus S&P 500. Semi-sector as a whole was down over 7%. Interestingly, financials and energy stocks, some of the best performing sectors today, along with regional banks. We've been talking about this as a pretty big contrarian trade. A lot of people had written off the regional banks, too exposed to commercial real estate. Valuations had gotten pretty cheap, and that's really strong price action this last couple of weeks. Still a rotation there, and a bit of defensive rotation today in healthcare, staples, utilities holding up, and REITs trading higher. So once again, it's not what I'd call a bear day in the stock market, where everything gets indiscriminately sold. All sectors in the red, pretty much over 90% of stocks finished down. Again, we're getting mixed results, bit of a changing of the guard and rotation. We can see that in the spread of value versus growth, pushing up over 3% today. And just putting that into context, the sell-off we had in semis today, 7%, it's biggest daily sell-off we've seen since the really volatile days, early 2020. Even though the VIX is low, the leading sector over the last year is getting a bit more volatile. And that came on news. The Biden administration is weighing tighter China trade restriction, something they've been doing for a while and looking to accelerate, as they want to limit China's access to advanced American technology and prevent them from accelerating and advancing their military as well. In addition to that, we heard from the likely next president that Taiwan ought to pay the US for its security costs, and other comments against Taiwan and how they've taken a lot of America's chip manufacturing. And so we shouldn't be surprised that semis got hit hard after hearing all of that, and the China risk is already playing out and nothing's even really happened yet. But like I'd been saying, semiconductors are technically super stretched here, just looking at the monthly chart. And so any excuse for a bit of profit taking and sell off, especially at these elevated levels, should come as no surprise. And here's a look at a handful of large American stocks with heavy exposure to China as a percentage of revenue. When Resorts come in the top at 75%, and you can see quite a few chip makers are in there. So they're not only reliant on Taiwan for manufacturing, they're also reliant on China with selling their product. So there is the potential for an escalating US-China trade war, and semiconductor industry could be a key pawn in that. And I think a lot of people underestimate how much leverage China truly has if they want to flex their muscles. But like I said, who knows? We may get a surprise the other direction, and a change of government and Xi Jinping may be able to negotiate something in favor of all involved. But one thing's for sure, this issue isn't going away anytime soon. And so I continue to maintain that mega cap tech and semiconductors may have a lot more risk in them than's been currently discounted by the market. And so far it has been a vicious rotation. Over 1 trillion of market cap wiped off the Magnificent Seven just a week of trading. But like I'd also been saying, the market S&P 500 had gotten a little ahead of itself even for a really bullish election year, which averages out about 10-11% full year gain. Here we are in the green line, having already slapped on 15% mid-year. Again, it's not really surprising to see the market take a breath, consolidate, pull back, and who knows, this could even turn into a 10% pullback, which again wouldn't be outside historical norms. And just looking back in history, at this point in the year, it's not many other years they've gone too much further above it. There's quite a lot of consolidation and pullbacks around there. And we can see that in some data I showed you guys last week as well. August is the worst month of the year for equity flows. And the last 2 weeks of July can be a little soft as well. We just came out of the best 2 weeks of the year, which was the first half of this month. And the second half's a bit softer, and the first half of August. Bit of softness as well. And a lot of time that can even accelerate into late September, sometimes October. And you'll typically see a bottom around that time, and the market will usually rally going into Christmas, especially in a bullish year like the one we're having now. So we very well could be in for some more softness and consolidation in the S&P 500 and NASDAQ, since they've been driven by mega cap tech and semis, and the price structure and all those big stocks has technically changed. But like I said, it's not a market-wide sell-off. We don't have that breadth across the board like I showed you. Dow Jones Industrial actually finished up today. Small caps still holding in there, and value stocks, financials, energy, all finishing the day higher. So once again, it's an extension of this rotation we've been seeing. And just stepping back again for the overall market, we actually got the Whaley breadth thrust signal, and that's triggered when the number of 5-day advancing stocks exceeds the number of 5-day declining stocks by 3 to 1. Looking back in history over the past 60 years, had that signal 14 times, and a year later, we're higher 100% of the time for an average gain of 23%. And in fact, 6 months later, we're higher 93% of the time, an average gain of 17%. So once again, another good bullish technical signal we're getting in the market here. And it wasn't just United Health breaking out to new all-time highs, helping to drive the Dow Jones higher today. Actually, 22 of the 30 Dow stocks are up. So a bit of breadth there and blue chip leading the way today. And there's a look at the top performing industries today. Insurance, packaged foods, tobacco, food, agricultural, utilities, some REITs. So a bit of a defensive rotation. Stocks that are cheaper. And there's a look at the worst performers today. Semiconductors, independent power producers, uranium, renewable energy, computer hardware, solar, and silver pulling back. Some of the best performing sectors of late, having some sharp pullbacks today. Warren Buffett's stock, Berkshire Hathaway, hit a new all-time high, closing in on the $1 trillion market cap for the first time ever. And so we're seeing this broadening of market breadth, which is good for the overall stock market. And again, it's no surprise to see mega cap tech taking a pullback. Had gotten a bit stretched there on both technicals and valuations as well. Just looking at the valuation composites, still a big spread between US growth and small cap, with smalls 1.5 standard deviations below the mean, and growth almost 1.5 standard deviations above. And remember, the earnings growth from small caps is expected to exceed that of large caps next year. However, not everyone's on board. Still plenty of doubters and skeptics out there of this rotation into small caps. One of those being John Higgins from Capital Economics said the fact that large cap stocks are still near record highs suggests no rotation has taken place, and he is not convinced. He said the recent market action shouldn't be thought of as a rotation, as he said that implies investors are selling large cap stocks and using those proceeds to buy small caps, pointing out the large caps are still just a few percentage points off all-time highs. Well, I don't know if he said this before today's market action, because a few of them are a bit more off a few percentage points from their all-time highs. Said he'd need to see more evidence of a sell-off in big tech to be convinced that there is a rotation underway. Well, I mean, that could be pretty late. Like I said, if you wait for everything to be perfect, you're normally the last one in. And he's saying big stocks are only a few percent off their all-time highs. Well, I'd say the most important stock in the market for the last year is now 16% off its highs, and technically we call it a bear market if something goes more than 20% off its highs. However, that being said, I wouldn't be surprised if mega cap tech does find its footing soon and just continues to go into a range-bound consolidation. They still do have good earnings growth. I think they were just due for a bit of a breather. And this news about Taiwan and China, I think, is good calls for that. But just stepping back and looking at the economy and markets, Goldman Sachs Financial Conditions Index looks at a lot of things. Availability of credit, how healthy markets are. That's trending down, showing conditions are loosening and are easy. And so that's a tailwind for markets. We've also got US industrial production on the cusp of breaking out to all-time highs. Typically that'll trend down going into a recession and bear markets. Counteracting that, as we are getting a bit of mixed economic data, is consumer sentiment. That's trending down, and that's something you also see going into recessions. However, for now, the unemployment rate, jobs market as a whole, retail sales, other indications of the consumer are still holding up okay. And for now, we're still in that Goldilocks scenario of inflation cooling, the jobs market just loosening a little bit, other global central banks have already cut rates, the trend around the world has been towards loosening monetary policy, and so the US Treasury market and Fed fund futures are also pricing in the Fed is ready to cut, given only the slightest chance that they'll stay on hold in September at 2%. With it almost a near certainty the Fed will cut rates at the last meeting before the federal election on the 5th of November, which is going to be really interesting to see if Jay Powell does go ahead and take the cue from markets. Economic data, other global central banks, I'd say he's pretty much got the green light to go ahead and cut here if he wants to. And I wouldn't even say it'd be all political either. Like I said, just looking at the data, pretty good gap now between CPI and where the Fed funds rate is. He's definitely got room to cut. Obviously, that could be seen as political, and I'm just wondering whether it plays into his thinking. And who knows, can't rule out the possibility that he does hold and just waits till after November to maybe start his move. Because either way, he'll have to acknowledge a changing administration, and he may just change his inflation forecast with that as well, which could change the trajectory of the Fed funds rate. But as far as I can see, we haven't really heard from him too much on that, and he always reiterates that politics doesn't play into his thinking. So let's just see what happens come this September. Moving on, commodities. Oil bouncing back as crude inventories post a third straight weekly fall. They're going back and forth a bit on inventories, and of course demand still holding up at this time of year in North America, the driving season across summer. Also had gold find a new all-time high today, continuing its rally, changing markets, changing events, with similar price action to bonds, getting excited by the prospect of lower rates around the corner. And there's a look at daily gold futures, almost touching $2,500 an ounce today, still sitting at all-time highs there. Natural gas still pulling back sharply, bit of a turn down in uranium, with wheat and corn still a bit soft here as well. There's a look at the economic calendar today, building permits coming in a bit hot, along with industrial production that I just showed you. Tomorrow we'll get jobless claims, a few more Fed speakers, and not much else out from the States for the rest of this week as we move into the thick of Q2 earnings season. And so just looking at Apple, Microsoft, Amazon in 8 days, Alphabet, Google reporting earnings in 6 days, and Meta in 2 weeks as well. So over the coming week and two, we've got mega cap tech reporting, and they're selling off going into that. Led by NVDA, which always reports much later than the rest of large mega cap tech. They're due out in 42 days. But I'd be surprised, unless we got any real new big surprise news, if NVIDIA took out this gap just above $100 a share. We very well could come down and test that, and that'd be a sizable 35% or so pullback from all-time highs. And again, just looking at the S&P 500, which has been led by these mega cap tech, we have had a really sharp 14% rally just off that late April low. So again, it's no surprise to see it have a bit of a pullback here, and it very well could have a few more days to go. May also see the Russell 2000 consolidate, but again, I'll be looking for this key breakout zone to be defended. We may come down and retest, maybe halfway, maybe all the way, and we'll keep this zone in here as a bit of a technical line in the sand. And just looking at the Dow Jones Industrial breaking out to new all-time high, along with value stocks, financials and energy moving higher, really swift move up in regional banks. It's got all the hallmarks of a continued and massive market rotation. Thanks very much for tuning in with me today, guys. Appreciate all your support, and I look forward to seeing you again tomorrow night. Cheers.